Builders are drowning in inventory. Unsold new homes are piling up across the country. And to a lot of people, this looks exactly like 2008, when a glut of new home supply caused the largest housing market crash in modern history. But here's what nobody wants to admit. Those homes aren't just sitting there waiting for prices to fall. Investors are circling. Wall Street is secretly buying up the very homes you thought would crash the housing market. So let me ask you, what do you think happens to all these unsold homes? Do they crash the housing market like 2008? Or will investors swoop in and change the ending? Drop your thoughts in the comments. I want to hear where you stand before I show the data. Now, a lot of people are skeptical. They see these headlines that say new home supply is piling up fast, and they think it's just media hype. But I have numbers to back it up. Let me show you what I mean. According to the U.S. Census Bureau and Resi Club Analytics, we currently have about 120,000 new unsold homes in the U.S. And I have to go back 17 years to find that much inventory in the new home market. Now, the scary thing is, during the great financial crisis, we had over 180,000 new homes available on the market. And we all know what happened when we had that many homes for sale. That glut of supply in the housing market caused home prices to completely crater. As you can see from Fred Economic Data, home prices before the GFC peaked at $257,000 in 2007. But that buildup of inventory caused them to fall and fall fast, all the way down to $208,000. And that's a drop of around 20% in just a couple years. Now, I should know how bad this carnage was during the GFC because I was at the ground level. I saw the glut of inventory and I saw the prices collapse. So you flash forward to today and builders have a ton of inventory again, even though many people are saying, hey, we still have a shortage of housing in the U.S. Do you believe that? After prices collapsed because of all that home supply, investors stepped into the housing market and started buying properties and turning them into long-term rentals. On the left-hand side of this chart shows the investor market share. And you can see back in 2010, right after the GFC, investors owned a very small portion of the U.S. housing market. But then look what happened. It went up, and it went up fast. Investors took advantage of the low prices and added to their portfolios. And they quickly figured out owning rental properties is profitable. But don't get it twisted. It's not just institutional investors. A lot of this buying happens from mom and pop investors and even accidental landlords who are left homes in divorces, or because a loved one passes away, they're left with a house that they turn into a rental property. Heck, you probably know somebody in that situation. And believe it or not, they're a mom and pop landlord and part of this market share. A lot of you have commented that you hope, wish, and want the United States government to do something about investor purchases of homes. In fact, many of you have said you're waiting on that to happen before home prices actually become affordable. Let me ask you a question. Do you see any situation over the next 10 or 20 years where the government will ban investing in the housing market? Comment below. Let me know what you think. Quite frankly, I don't see that happening. Now, we all know that investors, both big and small, gobbled up houses when they were cheap after the GFC. And that buying continued even into COVID. But then interest rates spiked in 2022. And according to Resi Club Analytics, they say overall institutional scatter site acquisitions, which are single family houses, remain fairly subdued since interest rates spiked in 2022, with the number of institutional landlords actually being net sellers right now. So many of these big investors are actually selling more homes than they're buying, but not all of them. Invitation Homes, which is one of the largest institutional investors out there, they're partly owned by BlackRock. They owned 85,905 single-family homes at the end of quarter 2, 2025. And guess what? That's up, not down. Up from 85,261 homes at the end of Q1 2025. And something I'm seeing in this chart that's a big red flag. Back in quarter 3 of 2023, a huge institutional landlord that owned 2,000 or 3,000 homes unloaded all those homes because they just couldn't make the numbers work anymore. But guess where those homes went? Well, you can see it right here. Invitation Homes. They bought over 2,000 homes from a company called Starwood. And you can see the green bars every quarter. They continue to buy homes despite what you may have heard from other people. Remember, I'm not going to give you the hype. I'm going to give you the data. I'm going to show you what's really going on. I'm not going to tell you what you want to hear, but I'm probably going to tell you what you need to hear. In fact, according to Redfin in their data center, you can easily see that the investor market share has continued to move forward despite the higher interest rates. And this isn't just big investors. Remember, this is all investors. And right now, investor market share of purchases is 19% of all homes sold. So if you're someone on the sidelines waiting for this housing market crash and you expect that you're not going to have any competition from investors, I don't want you to fool yourself, because what I'm seeing tells me that investors are still in the market and they're ready to pounce. Now, if this headline doesn't scare you, nothing will. Look at this. Invitation Homes says home builders are offering them pretty significant discounts to move inventory. This Resi Club article basically goes into the fact that home builders are taking their unsold surplus homes and they're unloading them to investors. Rising unsold completed inventory in certain Sunbelt markets has builders leaning on investors to keep sales volumes up, highlighted by Lennar's launch of an investor-focused portal this week. I'm going to show you that portal here in a minute. You're not going to believe what you're going to see. It's crazy, and you can actually go on the portal and check it out yourself. And they have a quote in here from Invitation Homes CEO. Remember, they're partly owned by BlackRock, and he says, when we're looking at some of these opportunities, he's talking about new homes, specifically right now, things that are coming in from the home builders where there's sort of inventory they want to move. We're getting pretty significant discounts going in, which allows us to be really conservative on our underwritten rents. So right now, today, these investors, particularly these big investors, are negotiating with the largest home builders across the nation to gobble up their unsold homes. But it's not just big investors. Listen to this. As public home builders work to clear rising levels of unsold completed inventory in softer Sunbelt housing markets, they're not only turning to institutional buyers, they're also stepping up efforts to attract the housing market's biggest investor group, mom and pop landlords. Look no further than this week, Lennar launching the Lennar Investor Marketplace. The home builder, which ranks number 129 on the Fortune 500 list, says the portal allows investors at any level to browse curated new homes and make an informed, data-driven decision. So in essence, Lennar Homes has said, you know what? We're not going to wait for a GFC style housing market crash. We're going to unload our unsold homes right now to people that will buy them and have money. Who's that? Investors. Now, let me show you the Lennar Investor Marketplace, because this is pretty crazy. You can come to this link. It'll be in my description below, and you can set up your own account on this Lennar Investor Marketplace. Something that jumped out immediately to me in this is that Lennar is offering a interest rate of 4.99% on a 7/6 ARM adjustable rate mortgage. So they're not just offering these crazy incentives to owner occupants who want to move there and live in the home. They're offering the same incentives to investors. Comment below. What do you think about that? As you can see, they've got homes available for investors all the way from Indiana to Seattle, down to San Diego, into Texas, out to Maryland, down to Florida, and everywhere in between. For example, here's a home from Lennar in the Kingwood, Texas area. It's actually in Crosby, Texas. It's a 4-bed, 2.5 bath, 1,900 square foot property. And it's going for $228,990. And they actually show you the pro forma and the rental analysis right on the screen. So here you can see the purchase price for $228,000. You can see the down payment, which is 25%. But you can change that percentage if you want to. The estimated monthly rent, I don't know Texas that well as far as rent, so I don't know if you can get that or not, but it seems like reasonable rent to me, $1,967. And then you've got the estimated home appreciation, 5.56%. I don't think homes are going up there 5.56% right now. I think they're dropping in value, but nonetheless, then you can get a mortgage rate, they're saying at 4.99%, but that's an adjustable rate mortgage, not a locked-in 30-year rate. And I can tell you firsthand, as somebody who's bought investment properties on an ARM, it's very, very volatile. You got to be really, really careful there. But this particular property is going to generate a whopping $1,407 in annual cash flow. Not that good. And the annual cash flow return, the cash on cash return, they call it, is 2.3%. Very, very poor performance. And the total return over 5 years is $76,000. But what they're doing is taking into account the appreciation, just not the cash flow. Then you can look at the detailed pro forma to understand exactly what they're using for closing costs, how much the property taxes are they're estimating, the insurance, the HOA fees, repairs and maintenance, property management, the vacancy loss, which they only have at 5%. I always use 8% at least, sometimes 10%. So the total annual expense is $11,088. Now, if I was interested in buying this property, which I'm not because these returns are horrible, but if I was interested, I could go ahead and start a purchase here and actually add the property to my account. I added one earlier in Indianapolis just for S&Gs. But if I add this to the cart, then I can say, all right, start my purchase. So it says start the purchase. Congratulations on starting the offer process. Offers are non-binding. The following screens will guide you through the buyer process. Once submitted, someone from Lennar will reach out to you on your offer. So if I hit start offer, I can actually fill this out and then put in my offer price. So I'm not really making an official offer. They said it's non-binding, but it's just a way for me to start the conversation and for a salesperson to get my info and reach out to me. This isn't really a crash. What we're witnessing in reality is just a transfer of wealth and ownership. While we do have a 17-year high of new homes available for sale, the major difference between now and 2008 is that Wall Street and small investors have figured out, hey, housing is a great asset to be in as long as the deal makes sense. These builders and even existing homeowners with homes that have been built over the last 30, 40, 50 years, as the prices start to come down in some markets, and heaven forbid, if interest rates come down, these sellers know that investors may step in and buy these assets. I mean, you correct me if I'm wrong, but in 2008, Lennar and other home builders weren't selling to institutional investors or investors, period. And they certainly didn't have an investor marketplace online across the country. Now, I'm not saying the housing market is completely going to come through this thing unscathed. We probably will see some price decline and some carnage in many areas of the U.S. And who knows, if investors decide, you know what, we don't have any money, we can't buy any homes, then there'll be plenty for everybody to purchase. But if you're waiting for 2008 version 2.0, you may be waiting forever. I mean, as a crash fan, you probably want blood, but investors want cash flow. And so far, they're winning. And so my advice is, don't wait to act. If you want a home, even a home at a discount, there are ways to find those deals today. I'm not saying run out and buy a property at an insane price and overpay, but I am saying to have a plan in place and understand how to find an opportunity off market, an opportunity directly from a seller, even from the MLS, but do so in a strategic way where you're making offers far below asking price. If you think home prices are going to drop 30 or 40% and they're overvalued by 30 or 40%, make offers 30 or 40% off of current retail. I mean, there's no law about going to one of these builders like Lennar and saying, hey, you want 228 grand for the property? I'll give you 170. Or do what I do, drive around the market and find properties that look like they've been forgotten about or ones that need a lot of maintenance. Then contact those owners and make an offer that makes sense for you. Because every month you wait, more and more homes slip into investors' hands. I mean, I showed you the proof today. Investors haven't gone anywhere. They continue to buy properties. And if you're waiting for the government to solve that problem, good luck. Because the question isn't if you should act, it's how you should act. Don't let these large investors control your destiny. Beat them to the punch. You have an advantage if you're an owner-occupant because many private sellers do not want to sell to an investor. They'd rather sell to somebody who's going to live in the home. And that could be you. But if you just sit on your hands waiting for the crash, more and more investors will scoop up more and more homes. Don't wait on someone else's failure for you to be successful. Now, if you learned something on today's video, do me a favor, hit the like button, share my video, subscribe to The Housing Nerd, and YouTube thinks you'll like my next video right here.